Today, is shorter better? The DFA Daily to the 11th of May 2020. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. The latest from Roy Morgan revealed that in April 2020, business confidence was down 18.2 points, or down 19.1%, to 76.9, plunging to a second consecutive record monthly low. The sharp decline in business confidence in April was driven by more businesses, at 64.8%, up 25 percentage points, saying their business is worse off financially than this time last year. Businesses being less confident about the Australian economy into the future, with nearly three-quarters, actually 73.2%, and up 10 percentage points, expecting bad times over the next year, and over half, at 58.4%, up 12.3 percentage points, expecting bad times over the next 5 years. Only a third, at 35.9% and down 10.3 percentage points of Australian businesses, said the next year will be a good time to invest in growing their business, while nearly half, at 48.2% and up 6.6 percentage points, said it will be a bad time to invest. Some Australian businesses are already looking past the pandemic and are growing more confident about the next year, with 43.1% and up 3.6 percentage points expecting the business will be better off financially this time next year, while only 27.6% expect business to be worse off. Overall, the April 2020 business confidence level was 26 points lower than it was a year ago, and a significant 37.7 points below the long-term average of 114.6. Business confidence for April came in slightly below the ANZ Roy Morgan consumer confidence for the month, which was 79.8. The biggest declines were for transport, postal and warehousing, down 43%, information, media and telecommunications, down 43%, accommodation and food services, down 40%, property and business services, down 37%, construction, down 34%, and education and training, down 26%. There were, however, a few industries that managed a small improvement in April, including public administration and defence up 1%, wholesale up 5%, manufacturing up 4%, and recreation and personal up 16%, to a still well below average rating of 65.2. The fall was not uniform across all states. The largest fall was in New South Wales, with business confidence down 33% in March to only 67.9. Business confidence also fell significantly in South Australia, down 29%, and Queensland, down 18%. In Victoria, the index fell marginally by 6% to a new record low of 82.4. However, there was better news in the two most isolated states, with the index up 5% in Tasmania and 8% in Western Australia. Also, though, there was some good news, with business confidence in the second half of April showing a distinct improvement over the first half as Australia flattened the curve of the virus. In the first 2 weeks of April, the index hit a low of only 69.3, but averaged 82 during the second half of April. Now, last Friday, the RBA published their statement on monetary policy, and we discussed the main points last week. But I wanted to dig a little more today and pull out some of the key points. In short, I've read the report, so you don't need to. Their SMP is published every 3 months and looks 2 years ahead. It's been appallingly inaccurate for years due to the RBA's bias towards optimism, the use of old data conveniently selected, and the lack of real appreciation as to what's happening with real households and businesses. Last time, which was only in February, their belief was that economic growth was going to rise over time, consumers were going to start spending again despite the evidence to the contrary, and unemployment was going to plunge towards 5% and meet their aspiration of 4.5%, at which time wage rises would start. Welcome to the pre-COVID fairyland. The real growth levers then were more household debt, mainly driven by higher home prices, more migration, and more resource exports. The new report includes 3 scenarios: a baseline, an earlier economic recovery, and a later recovery. The baseline is the central scenario, and so we're going to look at that. On employment, it predicts a drop of more than 7% in the first half of this year, most of it in the June quarter. Of the 13 million employed in March, 7% is likely to become unemployed, and that equates to 900,000 people, or 1 in 13 to lose their jobs. Now, of course, ScoMo has been talking about a snapback to where the economy was before the crisis, and the RBA talked in the S&P by December next year seeing a 6% rise in jobs. But remember that 6% of a small number is a lot less than 7% of a big number. I keep having to make this point. It's the same argument for house prices and investment. You need a bigger percentage rise off a smaller base to get back to where you started. The RBA central forecast is to have fewer people in work all the way out to mid-2022. The forecast stops there, of course, and we've no idea, really, when we'll get back to where we were. So no return to pre-crisis levels anywhere in their analysis. And the RBA says that after economic activity falls by more than 8% in the June quarter, it will come back up 7% in the year that follows. But we will be worse off. Living standards will be missing the normal 2 to 3% per year increase. And the killer in the data is the expectation that household spending, which accounts for around 65% of gross domestic product, will bounce back from a 15% fall in this quarter to a 13% return later. Now, how likely is this? Well, the DFA data we presented yesterday says it will not happen. Those who can are saving, and those who cannot are building up more debt. Confidence remains shot. And reflect on this: during the global financial crisis, we tightened our belts and then kept them tight for years, saving far more than the official forecast expected, in part because we'd been shocked by what happened and we felt uncertain about the future. I think we're going to see the same again. So I cannot really see a V-shaped recovery happening anytime soon. And the RBA's statement also included insights about future residential construction and mortgage volumes. Dwelling investments are expected to be significantly lower over most of the forecast period than was forecast in the previous statement, they said. The trough in construction activity is now projected to occur in late 2021, half a year later than previously expected. So the RBA noted that it expects home lending volumes to dwindle in response to weakening housing market sentiment. More timely indicators of housing market activity, including auction clearance rates and housing turnover, suggest that commitments will decline in coming months, the RBA said. This would also be consistent with the sharp decline in economic activity and incomes. However, despite the expected drop-off in home lending volumes, the RBA expects banks, particularly the Big Four, to retain much of the value of their mortgage books, with loan deferrals and an increase in redraws offsetting the decline in new business. And the latest data from the Australian Banking Association has revealed that collectively the banks have now deferred around $200 billion in loans since the relief program commenced. Major banks have reported that around 9% of borrowers have applied to defer their payments for up to 6 months, with effect from April, the RBA said. By itself, this would tend to push up housing credit growth by around 0.5 percentage point in year-end terms over the next 6 months. But the RBA continued bank liaison indicates that some households have been accessing funds in available redraw or offset accounts to help support their cash flows. This will also reduce total loan repayments and contribute to stronger credit growth. Now, the RBA said, this would be partially offset by additional mortgage repayments made by some borrowers for precautionary reasons or merely because their other opportunities for spending have been curtailed. And of course, this comes as 3 of the Big Four reported contractions in their loan portfolios over the first half of the 2020 financial year. The big banks' weak home lending performance added to their earnings woes, with the rise in credit impairment charges costing the lenders a cumulative $6.2 billion. So, whilst we might not see overall lending growth from new loans, what we're actually seeing is more people with existing loans borrowing more and getting ever deeper into debt. I don't think that's a very good recipe for a good outcome personally. And elsewhere, the truth is beginning to emerge that population growth, one of those hidden dynamos over the past decade, is waning. The government suggests that there'll be around 330,000 less migrants than expected in the next 18 months, according to UBS, who sees population growth slowing to 0.5% year over year in 2020, and that will be the slowest rate since 1916, with reports suggesting that over 300,000 tourists and temporary residents have already departed Australia by mid-April, and that perhaps another 300,000 may leave by the end of 2020, a collapse in Australia's net overseas migration, or NOM, and visitor arrivals is inevitable, they said. Indeed, the government's own expectation is that NOM declines very sharply from the financial year 19 level of 240,000 by more than 30% in financial year 20, with an 85% fall in financial year 21, compared with the 2019 Commonwealth budget assumption that would represent a shortfall of around 330,000, or 1.3% of the total population. Their detailed analysis suggests that NOM is likely to turn negative from the second quarter 20, probably until the fourth quarter 20, albeit official population data may not report this reality until 2021 because of the lags in reporting and measurement, where NOM includes anyone in Australia for 12 out of the last 16 months. Much of this fall is driven by a collapse in temporary visitor arrivals, given travel restrictions, as well as lower student and working visas, which is only partially offset by an increase in Australia's returning home. From early 2021, they expect a gradual normalisation of migration flows, with a short-term spike in permanent arrivals, largely as a catch-up for those granted permanent visas that again become able to travel. And this would see NOM in the calendar year 20 fall by around 20,000, a record low, and the first fall in the data. However, this would rebound up 200,000 by the end of 2021, assuming borders are largely reopened by the end of this year. And I'd say that's quite a big assumption. This would see population growth slow from a strong 1.5% year over year in recent years to around 0.5% year over year in 2020. That's the lowest since 1916, before lifting to 1.3% by the end of 2021. However, they said there are significant risks in both directions around these forecasts, given the uncertainty of when travel restrictions will be eased, what the government policy on migration intake will be amid very high unemployment ahead, and if behaviour, for example, demand of foreigners to migrate, changes. That said, they said, in the medium to longer term, they think this crisis will likely see Australia still remain an attractive destination for migrants, given the better health outcomes so far of COVID and the death rates compared with most overseas countries. And so Australia could actually see surprisingly strong migration ahead. And based on UBS forecasts for airline capacity, they estimate short-term arrivals will collapse 75% in 2020 and remain 40% below the 2019 level until the end of 2021. This is a huge challenge for tourism, which is around 8% of GDP, but it's not all negative. Australia's COVID-19 containment means it is likely that domestic travel will be permitted well before international travel, and given that Australians spend around 50% more on overseas travel than non-residents spend in Australia, there is some offset from domestic substitution. Further, they expect domestic air travel will remain subdued for some time. There is likely to be a rise in local tourism, for example, road trips, once the mobility restrictions are lifted. This fall in migration also sees their estimate of underlying housing demand fall sharply from 200,000 before to only 130,000 now in the near term, albeit before recovering towards 190,000 by the end of 2022. This will cause downward pressure on house prices, which they expect to drop by 10% and trigger, along with weaker income and uncertainty, a slump in dwelling commitments to less than 100,000 in the coming quarters and 120,000 in the calendar year 20. Low migration adds to the downward pressure on rents from the slump in short-term visitors, but they see housing undersupply re-emerging next year, and assuming more direct housing stimulus policy, they see a recovery in commencements to 170,000 in 2021. And finally today, there are a myriad of charts tracking the relative country positions relating to COVID. And there are, of course, massive questions about the real comparisons between countries, how affections are picked up and defined, and how they're counted. But I do quite like the Financial Times charts. The first is the pretty standard one by country. And on that basis, perhaps the US is loosening too soon. People have to go back to their normal lives, said Trump, pretty much saying that deaths from COVID-19 are a price they're going to have to pay. That alone actually disturbs me. In terms of cumulative cases, New Zealand is doing slightly better than Australia, and both are doing substantially better than the United States. Looking at the UK and Singapore, Australia is also doing much better there, at least at the moment. And the UK announced they're going to quarantine incoming visitors for 14 days, to which I thought, well, you're only doing that now? And the next chart shows the cumulative deaths per million, and on that scale the UK is actually ahead of the US, and Australia is much better placed. And the final chart shows New Zealand slightly above Australia in terms of cumulative deaths per million. And weirdly, it's Belgium of all places which holds the record for the highest count of cumulative deaths per million. Now, I have no idea why. They do serve great fish and chips, but I'm pretty sure that has absolutely nothing to do with it. As with all data, it may tell you something, but sometimes not so much. Anyhow, whilst we might be right to loosen the controls across the states, the longer-term damage is already being done and unemployment will be higher. If more people do get back to work sooner, then the government may save some of its support expenditure. But as the bank holiday on mortgage repayments and the higher benefits get removed, we think this will launch yet another economic shock on the economy. So a shorter lockdown period might be better, but the economic consequences, not so much. Whichever way you look at it, this is indeed going to be a tricky year. And before I go, a quick reminder that tomorrow evening I'm running a one-off live stream on Bitcoin's halving, and I'll be joined live by Alex Saunders from Nuggets News, and we'll be able to take your questions live on the YouTube chat, or you can send in questions before. I've already got quite a few to discuss. So I think that'll be an interesting session, given the fact that the halving is now upon us. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.